Explain your thinking here, Rebaca.
Sure. So essentially what happened over the last few years was that low rates have translated into narrower net interest margin, and together with lower credit growth during the period, that led to declines in net interest income across many banking systems in Asia. And this is detrimental for Asian banks because these banks rely heavily on net interest income as their key source of revenue. Over the next few years, we do see broadly three big downward forces on profitability. Firstly, margins will decline as central banks in this region are cutting policy rates in order to soften the impact of the pandemic. Banks in this region are also supporting borrowers affected by the virus outbreak through measures such as cutting interest rates or granting new loans under preferential rates. On top of all these margin pressures, we see credit costs to be rising because asset quality will weaken. Finally, and more interestingly, we see the pandemic to be accelerating digital transformation in banks. And as such, we do anticipate operating expenses to increase for some banks over the next few years as they ramp up investments in technology in order to cater to the needs of their customers who are increasingly moving their banking transactions online because of fear of the virus, lockdowns, as well as social distancing.
Rebaca, okay, we have, of course, the Monetary Authority in Singapore suggesting that the banks there cap their dividends to 60% of what they paid out before. Is that something that is likely to be practiced across the board in this industry? And do you see it actually 60% as being perhaps too little, perhaps like other ones in the UK, which have had to cancel their dividends entirely to shore up their balance sheets as being a more realistic proposition?
Well, generally, Asian banks are going into this pandemic with strong capital positions. But at the same time, I think Singapore is not alone in pushing out such measures. Many other parts in Asia, like Thailand, Vietnam, they have also restricted dividend payments for banks. And we generally see that as a positive because that will allow banks to retain capital and build up buffers against rising risk.
Okay, Rebaca, well, what about the bad loan situation? You talked about poor credit quality looking ahead, as many corporates, of course, have been suffering. Where do you see that concentrated more regionally speaking?
Well, we do have certain sectors that we anticipate more pain in, particularly the airlines, the tourism, and the hospitality sectors. But really, this pandemic is far-reaching, and many of the other industries will suffer second-order impact. I think beyond the corporate sectors, we do see retail and SME sectors to be hit as well, particularly if unemployment rates were to increase in this part of the world.
So can you clarify that, Rebaca? How bad would NPLs look like, given that, businesses are struggling and millions of workers are losing their jobs as well?
Well, the situation is volatile, and it remains to be seen the extent of the impact of the pandemic. Many of these loans in this region continue to be under moratorium. They continue to be supported by measures rolled out by the governments here. So it remains to be seen how the quality of these loans will look like when these measures unwind.
Having said that, Rebaca, how resilient then can banks be like those in Singapore, which the MAS has said they are resilient according to stress tests? Can they remain resilient if the pandemic were to persist? After all, Powell did say the economy's path is extraordinarily uncertain.
Well, indeed, it is a moving situation, very volatile depending on how the pandemic pans out. But going into the pandemic, we do see Asian banks, including Singapore banks, to hold strong capitalization. We do see that as a saving grace, but it remains to be seen the extent of the damage.
How about Indian banks? Stress tests have shown they're on thin ice, and the outlook on asset quality is not looking too good?
Sure. So in April this year, we have changed the outlook on all Asia-Pacific banking systems to negative, India included. We see the broad trends to be similar across Asia. So the negative outlook really reflects the effects of the pandemic. We do see operating environment to become more challenging. For Indian banks, particularly in terms of their asset quality, these banks have been under stress from their corporate loan book for many years now. And with the pandemic ongoing, we do see retail SME loans to also come under stress. At the same time, these banks also have sizable exposures to their non-bank financial institutions. And with the solvency pressure growing on that particular sector, we do see the risk of contagion there.
Rebaca, just final question here. You know, parts of the world have got a savings glut now. I'm talking about the US. What's the savings position like now in this part of the world, and how much can it mitigate some of what you've just been talking about?
Indeed. Well, it depends on how prolonged this pandemic really is. But you're right, the savings rate in this part of the world is high, and it does support banks' liquidity and funding positions.